real quick, every week I put together a video on investing, talking about a whole load of different topics. The whole reason behind why I do this is I'm trying to help people become more intelligent investors and know what they're investing in, where they're putting their money, and why they're doing what they're doing, or hopefully why they're doing what they're doing. For me, when I got started in investing, this was probably some of the most difficult things and concepts for me to understand and to learn. It was really, really, really hard. And I had to read tons and tons of books like this for a long period of time, years, honestly, before I actually figured it out. But I figured maybe I can help other people by putting these videos together and kind of explaining some of it. Anyways, long story short, what are we talking about today? Today, we're talking about risk. How do you understand risk? And more specifically, we're talking about risk in commercial real estate. Now, it's pretty interesting that this popped up, and I think I actually deleted the link to what I was looking at. But it's really interesting that this popped up over the weekend. Rite Aid declared bankruptcy. And I'm going to show you this. Let me share my screen with you. Boom. You should see my screen in like 2 seconds. Anyways, here you're seeing Rite Aid declares bankruptcy. Okay. What does this have to do with commercial real estate? Rite Aid, isn't that a publicly traded company? You know, what does this have to do with commercial real estate? Well, in commercial real estate, there's this thing called triple net leases. Triple net leases are basically where a tenant, like Rite Aid, is responsible for basically the taxes, the insurance, the maintenance on this property. The only thing that the landlord is responsible for is basically providing them a space to be in. Okay, Rite Aid or Starbucks or CVS or so on and so forth are responsible for all the other things. It sounds really nice because it allows you to be hands-off as an investor. But what does this do in terms of risk? What's the catch? Here's the catch. It's typically when you have properties like this that are leased to a Rite Aid or CVS or something like that, they're single site stores. That is, your revenue, your income for that property is dependent on that one tenant. If that tenant doesn't pay you or the tenant goes out of business, you're in trouble. Okay. Same thing if you own 1 or 2 single family homes. Your income for that single family home, your ability to pay the rent or not the rent, the mortgage, the insurance, the taxes, all that type of stuff is dependent on that one tenant not messing up. What happens if they do? Well, you're on the hook. So if we connect this to the stock market, which many people are more experienced of, or we've heard more about investing in the stock market than probably commercial real estate. You hear about diversification. All that means is, right, you're buying a bunch of different stocks so that not one single stock can hurt you. How do we apply this concept to real estate? The way we apply this concept to real estate is by not having one single tenant have so much power over our top line, our revenue, or our income, that they're messing up, messes us up. Okay, so what we're saying is we're diversifying our revenue coming to us. This is why, in my opinion, to me, multifamily is so appealing, because I don't have to worry about Rite Aid files for bankruptcy, CVS files for bankruptcy, Starbucks goes broke. I don't have to worry about that. I don't have to worry about one tenant not paying, because if I buy a property with 60 doors and one tenant doesn't pay, guess what? 59 others are still going to pay, most likely. Okay, then it comes down to management and operations and stuff like that. Anyways, the reason I'm talking about this today, the reason we're talking about this today when it comes to risk, is because a lot of times we want simple, easy mathematical numbers. Okay, what would be another thing that I could do? Another thing would be like, let's go to Yahoo Finance, and then we'll look up a company and we'll see how this applies. So I don't want to do NVIDIA. Let's go Microsoft and pull up their little stock sheet. When it comes to stock market investing, you go to a finance class at a university or something like that, you're going to talk about beta. You're going to hear beta a lot. And all beta measures is this movement, the movement of the price of this company relative to an index or benchmark such as the S&P 500. And that is somehow supposed to be a measurement of risk, okay? Why do people like this number beta? Because it's simple. It's really easy, okay? But does this number actually tell you how risky Microsoft is? In my opinion, no. Okay. In the same way, when we talk about real estate, there's no one simple number, okay, that's going to tell us how risky a property is. Being a really good investor means you have to have a good understanding of the business or the industry in which you're investing in. So maybe that's lesson number 2 for today. Lesson number 1 is that you want a diversification in your income streams if you're investing in real estate. The more you can spread out the risk to your revenue, the better it is. You can also apply that to stock investing. You want to make sure that the company you're investing in doesn't have one big client, that's where 90% or 80% or 50% of their revenue comes from one client. That's a very risky business, okay? So that's lesson number 1, diversification of revenue. Lesson number 2 for today. I actually just lost my train of thought. Lesson number 2 for today, though, is you need to have a good understanding of the industry or business in which you're investing in, okay? The more you understand it, the more you know it, the better you are going to be able to operate in that niche or vertical and be successful, whether it's in real estate, whether it's in the stock market. You might be a specialist in technology companies, and so maybe you look at smaller technology companies. You'd be able to find ones that are undervalued in market. If you're in real estate, you might look at a certain segment of real estate. We're in multifamily real estate. We're very, very, very good at what we do with multifamily real estate, and we want to continue to stay in multifamily real estate because we understand that. And it's the best way for us to reduce our risk relative to our return. Anyways, I wanted to jump on here today, just real quick, put this video together because I figured it could help somebody out there, okay? For me, when I got started in real estate, when I got started investing, I've invested both a lot in the stock market and in real estate. I do both. It was really, really hard to get this information. And it helped me out when I could hear somebody explain it to me and show me examples, which is what I'm trying to do. If this video is something that you liked, if it did do that, please leave me a comment in the comments below. Let me know that did that. Give me a tip to improve the video. And like, share, and subscribe. That's really good. I appreciate that. And hopefully I will see you next week. Thank you.